Welcome to WriterSpeak, dedicated to the written word and those who produce it. I am your host, Jeane Slone. I am the author of 2 historical fictions, She Flew Bombers and She Built Ships. Today in the studio, I would like to welcome Bill Matson. He is one of the co-authors of Data-Driven Investing. Welcome, Bill.
Thank you, Jeane.
It's nice to have you here.
Yeah, likewise. Glad to be with someone who appreciates somebody who can turn out a lot of and produce a lot of printed words, because that's what we did here.
Yes, I looked over your book and it is 500 pages.
It is rather lengthy, yes.
But I imagine a book on this subject does need to be that long. I also noticed that it is color-coded. Good to have you here so you can thoroughly explain the book to us.
I'd love to. Of course, we only have half an hour, so
Right.
I'll try to get as far into it as I can.
Yeah, and I will keep the questions as simple as possible. And I do not come from a financial background, so I won't let you get too complicated.
I appreciate that.
Well, I know you have recently moved to Sonoma County.
That's right.
And you have quite a background.
Well, thank you.
You are a retired CPA and hold a chartered financial analyst.
Yes. Mm-hmm.
You are a certified financial planner, accredited domestic partner designations. Bill is a graduate of Babson College and received his MBA from the Harvard Business School. He is currently on the board of advisors of the Admiral James J. Carey Foundation and serves as membership's vice president of the Harvard Club of San Francisco. Bill's career in finance spans over 35 years. Wow.
I look it, don't I?
No, you actually look younger than having worked in the field for 35 years.
Bless your heart for saying so.
So please tell me, Bill, if I've left anything out.
No, that's great. You can you pretty much summed it up well there.
Oh, good. Okay. So let's talk about the book that you co-authored. And like I said, it has it's nicely color-coded, and there's many graphs in it also. I think that aids in looking it over. So the first question, what is data-driven investing?
Oh, that's a good place to start, Jeane.
That's what I figured.
It's actually a pretty simple concept, and I can't take credit for having invented it. I guess all I can really take credit for is having used it in a book title at this point. But it's a very common sense concept, and it boils down to 3 things. First of all, what I do is I mine historical data to see what sort of strategies have been profitable in the past, as well as which strategies have been unprofitable, so I can avoid them. What I then do is develop decision rules for my trading that allow me to implement these strategies as breaking news and other sorts of data come to me. I find it's very important to know ahead of time exactly what it is that I'm going to do when news comes in. I need to know what to bid on a stock, how many shares to bid for, and exactly what I'm looking for in, for instance, a quarterly earnings report. So that's kind of the ongoing use of data. And finally, I self-generate data every day, really, because I go back over my trades and I look at my portfolio. I see what's working and I see what isn't. And then I trace that back to my decision rules, which maybe I need to emphasize some more than others because they're working better than others. I might need to tweak some, and I might need to stop using some either temporarily or permanently because they're not working anymore. So that's really what it all boils down to.
What are some of those decision rules that have worked for you?
Well, I've got lots and lots of them, but I would say that the majority of my money is made by following just 3 rules. First of all, the data has told me that small company stocks, on average, consistently outperform large company stocks. So I focus on small companies. Mm-hmm. The second thing that I learned from the data is that value stocks consistently outperform growth stocks, or at least they have over the years. And when I say value stocks versus growth stocks, what I'm referring to is, for instance, if you've got a company with a market value of $100 million, that is doing $200 million a year in sales, so therefore it's selling at 50% of its sales. That type of company will usually do better than a company with a $1 billion market value that's doing $200 million a year in sales. It hasn't caught up with them yet, but in the case of a Tesla, for instance, I think the figure is something along the lines of the company having a market value of $1 million for every car they've sold in the last year. Granted, you could have made a lot of money on Tesla stock during the past year, but at this point, with such a high valuation relative to its sales and its earnings, it's a very risky situation. So value beats growth, small company beats big company. And the third thing is that I buy on good news and I sell on bad news. And anyone who follows those 3 things will not necessarily beat the market in the short term, or even possibly in the long term, because who knows, but the odds are definitely with you if you do the 3 things that I just mentioned.
Yes, that was very easy to understand and very clear. So it's good for us to all know that.
Yeah, I'll try to keep it up.
I'll let you know if I have a question. How do you decide exactly what and when to buy?
Well, as I say, as far as the what is concerned, I'm looking for small companies that have low ratios of market value to sales, market value to earnings, and market value to book value. And for people who aren't familiar with the term book value, that's basically what you have if you take the accounting value of a company's assets and you subtract their liabilities, you're left with their book value. It's a lot like a personal net worth. If you have assets of $1 million and you have debts of $500,000, you would therefore have a net worth or a book value of $500,000.
Mm-hmm. I see. I know you're not a big fan of mutual funds. Can you explain to us why not?
Yeah, absolutely. I mean, there's multiple reasons.
I mean, most of us who are conservative type people in investing will go for the mutual funds.
Yeah, and it's kind of a shame that not everybody, or truth be told, very few people are aware of the problems inherent in mutual funds. And I've actually I jotted down a few here because there's so many. I have trouble sometimes, rattling them off the top of my head.
I'm happy to hear you read.
Okay.
Believe me.
Well, first of all, generally speaking, unless you buy a no-load fund, there's going to be some compensation for the person who sold it to you.
Now I have to interrupt you. So what is no-load fund?
Okay, a no-load fund is a fund that does not have an upfront sales charge or sales load. Okay, and even in the case of some no-load funds are distributed by salespeople. So rather than getting something up front, they get it on the back end. Maybe something on the order of 0.5% per year for every year that the person stays in the fund. So there's sales commissions to contend with usually, but even if there's no salesperson involved, there's still operating expenses for running the fund. There's all kinds of accounting and marketing and that kind of thing, which ultimately can only come from the pockets of the investors. But there are other problems too. So for instance, right now would be a particularly bad time to buy a fund that's invested in stocks, and particularly a fund that has been very successful in the past year or so investing in stocks. Because you see, mutual funds have to pay taxes of their own, just as the investors in them do. And what happens is that if you buy a fund that is very, very much up, what you're likely to be doing ultimately if you hold on to that fund is to pay taxes on other investors' profits because the money has been made already. It's reflected in the price that you're going to pay for the mutual fund, but until the mutual fund sells those shares and actually realizes that profit through the sale, they haven't created taxable income. So it's a little bit like musical chairs in that if you're the one who owns the fund when they're taking their profits on the holdings that are up, the fund is going to be going down, obviously, to the extent that it pays those taxes, and so in effect, you as the investor would be paying them. But the other real problem with mutual funds is that aggregating a lot of money in one place has a downside. In that when a large fund decides that it wants to go and buy a stock, like say Apple, for instance. If I want to buy it, let's say it's trading at 500, I can buy a share for 500, or I can buy 100 shares, or probably 1,000 shares for 500. But if somebody, and you have to remember, some of these mutual funds have tens of billions of dollars in them. So to take a meaningful position in something like Apple, it's highly likely that they could start buying at 5 and on their own drive the price up to 5, 10, maybe even higher, depending on how they time their orders. So basically, we like to say that mutual funds are like jockeys, in that the bigger they become, the worse they perform.
So tell me, when you buy or sell a specific stock, what do you consider when figuring out how to price and size your order?
Well, especially because I deal in very small company stocks. Very, very often the stocks that I hold, they don't even trade some days. So I have to be very careful, first of all, not to drive the price of them too high all on my own when I step in. And also I have to be aware that someday I'm probably going to want to sell these stocks. So I take into account just how big a position I believe that I'll be able to economically purchase as well as economically sell at some point down the road. And another thing is that let's say that I can put in some large orders without disturbing the market too much. I may still decide that I want to break up my trade if I want to buy 10,000 shares, I might buy 1,000 at a time, just so that I don't have to necessarily pay the asked price. And I should probably explain the difference between the bid and the ask price. I mean, a stock, any stock has a different price if you decide that you want to sell it at the market versus if you want to buy it at the market. The market for General Electric stock might be, say $25 bid, $25.01 asked. So it's no problem to put in a market order and pay $25.01, or to sell at the bid for $25. However, with a lot of the stocks that I deal with, to give one example, one stock has a 25-cent bid and a 50-cent ask. So therefore, if I'm in a hurry to sell the stock, I'm going to get a quarter for it. If I'm in a hurry to buy the stock, I'll pay 50 cents. So rather than get into that, what I will very often do is just put in the bid to buy at 30 cents and then wait for somebody to be over anxious to sell, and I'll buy it. And actually, after I own it, I may put in an order to sell it at 45 cents and wait for somebody who's over anxious to buy it from me.
It's very helpful when you can give concrete examples like that.
Oh, thank
you. It makes it easier to understand.
Thank you.
I loved one of your principles: good news begets more good news.
That's right, that's right.
And what is that, and what do you mean by that? That is really interesting.
Well, there's a natural tendency, and there are some very significant payoffs to managing one's expectations. And what this means for CEOs and CFOs, let's say, is that if things are going just great, but the world will be happy if they report $3.50 in earnings when with a little bit of work they could have reported $4. They will prefer to manage expectations downward, and save a little in reserve for the future. Just because of the nature of accounting, though technically you're not supposed to do it, what's done all the time is that companies manage their earnings. And if they've got a little bit more than they're expecting in this quarter, they can figure out ways to move those earnings into the succeeding quarter. And the benefit of that is, of course, if you take it all at once and you use up all your good news this quarter, that raises expectations for next quarter, and puts you in a more difficult position than if you had done the expectations management.
Is this a secret?
It's a very open secret.
Oh, okay. I was curious about that.
And the thing about it is that, like I say, you're not supposed to manipulate the accounting numbers, but nevertheless,
it's done.
It's done all the time. And so basically, I would rather be investing in a company that's probably squirreling away those earnings to be reported at a future date than be with a company that's, if it's reporting bad news, they're probably not reporting it to be as bad as it really is, because there's a real downside to being too candid with bad news. One might even borrow some earnings from a future quarter, just to get over the hump of this quarter, and thereby maybe keep your job for an extra 3 months at least.
Interesting. As a leader and a visionary, your book discusses a few issues about the future. What are some changes that you see are coming?
Well, some of the factors that I think are going to make a big difference in the investment landscape are obviously the internet has had a major impact already, and I believe it'll have even more in the future. Partly through this crowdfunding phenomenon that's become a lot more popular, that is really democratizing the investment process and allowing people to get into some of these companies at a very, very early stage, and really cutting a lot of people out of the loop who had traditionally been part of the process of growing a company, rather than going to venture capital firms, for instance. It's become more possible to advertise for investors, and also, as opposed to those individual investors having to wait until their stockbrokers call them with the stock, they're able to go into the internet and invest in these companies. But another thing that I see is rather than investing in companies, it's becoming more fashionable to invest in people. There's a company, for instance, called Upstart in San Francisco that is an intermediary that helps investors basically give people who are fresh out of school or maybe still in school seed money to start their businesses, and in return they take a percentage of these people's income.
I've seen authors do this.
Yeah. I mean, it's
and it's working.
Yeah, it's already grown to be important, and it's going to become a lot more important over the years, because quite honestly, I think most retail investors, that is to say individual investors, feel that the system is somewhat rigged and broken right now. And the other thing that I think is going to make a major change is that there's movement toward financial advisors having to take on a fiduciary obligation when they give people investment advice, as opposed to the current standard, which is in many cases just suitability. As opposed to fiduciary means putting your client's interests first. Suitable just means giving them something that makes sense. And really the difference there is something you can drive a truck through, because had there been this fiduciary requirement on the major brokerage firms and all the stockbrokers back at the time of the internet bubble, those companies would have been sued out of existence for the bogus research that was distributed at that time.
Well, to end our program, I'm curious, as well as I'm sure our audience is, could you give us a tip of just one stock you think is going to do very well?
Okay, I hope everyone will keep in mind that this is a small company and it is risky, but I think it's a sensible risk. I bought quite a bit of Astrotech, ASTC, this week, which is a commercial aerospace company. And what it does is it provides products and services for spacecraft to prepare them for launch. And anyway, what I like about it is, first of all, the CEO has been buying a lot of his own stock, his own company's stock, which is a great thing. Also, they trade at a very low multiple of their earnings. And also, they're trading at about a 30% discount to their book value. And in fact, their assets are very high quality. They've got a $13 million market value, but $12 million of that is in cash and receivables. The historical cost of their land, building, and equipment is over $100 million, but it's carried at the books at under $40 million. Total liability is only $14 million, but yet, as I say, it's at a 30% discount to book value, dirt cheap, and I like it.
Thank you, Bill, for joining us on WriterSpeak today.
Well, thanks for having me, Jeane. I enjoyed it.
And I wanted the audience to know Bill Matson is the author of Data-Driven Investing. To please look on the credits to view his phone number, to purchase the book, or to get further information on investments.